Hey guys, welcome back to the channel. And I'm glad to be back in my office at a normal desk and have my monitor and my camera set up because I've been all over recently. I've been doing a lot of hotel walkthrough videos because of that, because I haven't had my office set up. Life's been a little hectic. So separated from the Air Force, moved across the country. Me and Nicole got on a new house. We've been working on the hotel here in Tennessee. So it's just been all over the place recently. But here we are. It's not all set up yet. Still a little bare and echoey, which I'm sure you can tell. But the new office setup is on the way. So Deanna, who's in my mastermind and I did my last video with, the walkthrough at her hotel in Palm Springs, and you guys should go check that one out to see how this boutique hotel investing strategy actually comes together with the deal. But she's a really talented designer and is helping me with the office here, so excited for that new setup coming soon. And today's video is going to be an extension of my How to Invest in Boutique Hotels series, because I realized I left one important part out, and that's how to analyze boutique hotels. So we dug deep into how to find deals and how to raise capital for them, how to design them and operate them, and then how to scale with this strategy. But to do all that, you need to know what you're looking for, right? So you have to be able to recognize a good deal when you see it. And that takes some skill in how you underwrite your hotel deals, like where you get your rental data from, because it's different from short-term rentals. You have a hotel now, so AirDNA isn't just your one-stop shop for your hotel analysis. But even more importantly than that, I wanted to talk you through how I think about underwriting hotels and the why behind the numbers. Like, it's that subjective side where the deals are made or lost, really. Because it's not enough to just give a spreadsheet and then just send you out on your merry way, because that's not enough for this channel. I want to make you guys dangerous enough to go out and actually get deals. And that's the whole point of why I do this. So I wanted to start off today by giving the Northstar metrics of what you're going to be looking for in a good deal, right? So if a hotel deal you are underwriting doesn't meet these things, then it's a pass, right? Move on to the next one. Then I'm going to share with you the analysis sheet that I use, that I paid a developer a lot of money to create, because this underwriting is so specific. And I'll even give it to you for free. So you can go to the description below, grab a copy of that. So what are those Northstar metrics? These are the big deal or no deal numbers that you can use to make your decision to invest in a hotel or not. So some investors weigh different things more heavily in different metrics, like cash flow versus equity, but I'll share what I use to move forward with the deal. And even better, I'll share at the end of this what my minimum return thresholds are and what you should be looking for in your own hotel deals, so that one, you actually make enough money, and then two, that your investors earn enough to make it attractive for them to invest. So you have to hit both when you're doing bigger commercial deals, unless you self-fund your hotels. And if you have enough money to do it yourself without the investor, these metrics are the same to consider either way. So the first one that you should know and be familiar with is the cash on cash return, or the COC ROI. And this one is simple. It's money in compared to your money out. So if you invest $100,000 into a deal and you earn $10,000 per year in cash flow, you'd have a 10% cash on cash return. It's your $10,000 of cash flow divided by your cash invested. And look at that. We started off easy, but it only goes up from there, and I'll try to keep it quick but thorough and then run through this so that I don't math you guys to death. But this is important stuff to know. So the next ones are IRR, AAR, and your equity multiple. So that next Northstar metric is your internal rate of return, or the IRR. And I see a lot of people get confused with this one, and it is simplistically the profitability of the investment. And it's how you compare investment opportunities. So IRR is how you can compare a multifamily deal to a hotel deal versus a return in the stock market. And the higher the IRR, the better, excluding the risk factor. In more complicated terms, IRR is the discount rate that makes the net present value, or the NPV, of all cash flows equal to zero in a discounted cash flow analysis. And I can just feel the wheels turning right now. But the way I like to look at it is, it's a profitability measure of your cash inflows versus the outflows over time, because it incorporates the time value of money, meaning making $10,000 today is better than making $10,000 5 years from now, because that same $10,000 will be worth less in the future. So it measures how much you get back over time from how much you put in at the beginning. So for me, I'm looking for a high IRR with a solid cash on cash return. So the next is your average annual return, or your AAR. And this is the historical average growth rate of all your distributions and the cash flow from your liquidity events, or like a sale or refi. So this one can also be used to compare investment types, because the higher AAR, the better. And then finally, for the Northstar metrics, before we talk about how I weigh them in, is your equity multiplier. And this one's pretty simple. Like, it's how much you get back from how much you put in. So if you put in 100K and then you get back 200K, you have an equity multiple of 2. And then the higher, the better, obviously. But more importantly, how do I use these metrics to underwrite a hotel deal is a more important question. So I look for a minimum of 10 to 12% cash on cash, usually higher, but 10% is like a good screening metric, right? If it doesn't pass that, then move on to the next. And then I shoot for a minimum of 18 to 20% on the internal rate of return, a 20% average annual return, and a 2.5 plus equity multiple. So these are what I use to screen my deals. And the reason for that is comparing them to other asset classes. So I mentioned earlier that the IRR doesn't include the risk factor. Well, none of these really do technically. So that's why I shoot for these higher metrics. So an investor might be able to get a 7% cash on cash return and a 14% IRR on a multifamily deal or a single family or something like that, with a 2x equity multiple. And that's a pretty good return for a multifamily deal or single family. But in this case, in multifamily and single family are generally safe long-term investments as long as you're in a stable or growing market. But because I buy hotels that are generally riskier, the returns need to be higher. So if you have two investments with the same return, but one is riskier, then you go with the safer option all day, right? But it's the higher returns with hotels that draw you in. It's just like the reason for going for short-term rentals rather than long-term rentals, right? Because you're gonna get higher cash flow, more bang for your buck for the same purchase. So I aim for higher returns that you could get from a single family or multifamily investments, because otherwise just do those. But that's not why we want to invest in hotels, right? We want to invest in hotels for the higher cash flow. Just like investing in Airbnb versus long-term rentals, it's the same thing on a commercial scale. And an equity multiple of 2 is my minimum, because if I can't double my money, it's not worth doing the deal. But don't take that one by itself, like that metric alone, because it's really only good in combination with the others. And let me tell you what I mean. Because you can hold a deal forever and keep getting money back, but have a really low IRR because the time value of what you get out for what you put in can be really low. If you're going to raise capital, which most of you are, all this comes to a head at what returns you can give to your investors. I see a lot of boutique hotel deals, and I know a lot of people that have them now, and probably 80 or 90% of them raise money from investors. So in most cases, you need to be able to hit these metrics, like a 10% minimum cash flow, if not higher, right? 18% IRR, a 2.5x for your equity multiple for the investors. Otherwise, they're less likely to invest in you, and you can't fund your deal, and then you're left sitting on your thumbs. So when you think about what you need to deliver to them, your project returns for the deal as a whole need to be higher, right? You might need to hit a low 20s IRR and a 3 equity multiple and like a 15% cash on cash, so that you're making money, like I said earlier, number one, and then your investors are also making money. Now, before we get into the underwriting model, which you guys can pause this and download it and follow along, I want to mention the cap rate because that's an important data point in analyzing a hotel deal too, but maybe not how you think. So the cap rate is the unlevered rate of return, meaning if you bought the deal in all cash, the cap rate is your rate of return. So if you paid $1 million in cash and earned $100,000 per year in NOI or net operating income, that's a 10% cap rate. Follow me? But most people don't do that, right? They use debt to buy properties because instead of buying in cash for $1 million, you could put whatever, 200,000 or 250,000 down and earn that same 100,000 in NOI and boost your return. So you'd have to have that debt service on top of that, of course, but that 100K of NOI to 10% cap rate means you have $1 million property, right? It's worth that much. And that starts to get really cool when you can buy that property for 500 or 600K and increase the NOI and then make it worth $1 million or even more. Now let me explain hotel cap rates a little bit from my perspective. Usually they range in the 7 to 10% range. And some people say,
oh, if I can't buy the 10 cap, I'm not buying.
But how much does that cap rate at the purchase matter, I propose, if you buy it and can double the NOI? Not a whole lot, because you're still doubling the value by doubling the NOI if the cap rate stays the same. However, you can create a lot more value if you buy it at 10 cap and then the market cap rate for stabilized hotels in that area is a 9 cap, right? Because you're compressing the cap rate because the value is the NOI divided by the cap rate. So your value goes up either by increasing the NOI or decreasing the cap rate. And in most value add hotel deals, you can do both. So I say that point for you not to get hung up on the cap rate at the purchase, as long as you're not buying like a dog shit cap rate or a dog shit property at a 6 or a 7 cap rate. That would just be ridiculous because all the value add is squeezed out of it by you overpaying. So that's how I look at it. All right, now enough with my math talk. Let's see how this stuff works when you're actually analyzing a deal. All right, compadres, I'm going to show you how to actually analyze a boutique hotel deal now. And I said that AirDNA was not the one-stop shop, but it is a great place to start. So what I want to show you is, say that we're analyzing a property in Miami, right? So the first thing that you want to do when you log into AirDNA, search your market, you want to go to your listings and filter by like your 1 to 4 people in your studios to 1 bedrooms to match hotel-like listings, right? These are going to be smaller houses, condos, hotels oftentimes that you can pull from, and you're going to look for the most like properties to what you're analyzing, right? So you can get the most apples to apples. Now, you're not going to be able to get perfect data from AirDNA, and some of this is going to be subjective, which I'll talk about. Setting these filters and narrowing down, you can get a lot closer, right? So we're going to go to 1 bathroom 2. This will be more like the, actually we'll go to view all. This is going to be more like hotels. So now you can see there's a bunch of different sub-markets in Miami, right? You get the market dashboard as well to see how's revenue growing, how's occupancy going, how's RevPAR, which is really, the more important metric that I look at, because RevPAR is your average daily rate times your occupancy. So this is really RevPAR times your amount of bookings is really your gross revenue for the year. So that is more important to me when I look at these. So I want to know that RevPAR is growing, but when you're also looking at this, you can see like the revenue by the month to analyze your seasonality listing by revenue. So you can see how much it earns each month of the year to know when your high season and your low season is. And that's really, really important when you're analyzing hotel deals. I'm going to show you the sheet. You're going to break it out by month, right? You're not just going to do everything annualized like you would with STRs. Because typically it's like, here's how much you're going to make per year. Here's all your expenses per year. Here's how much you'll cash flow per year with a short-term rental. You do not do that for hotels because you have more fixed expenses, more overhead with labor typically. So your variable expenses are going to vary or differ much more than your typical short-term rental. So you break out your pro forma to monthly. So this is an important factor. Now, what you want to do to find your comps, right? The starting point of this, and I'll show you the sheet real quick just to put this in perspective. This is the acquisition model, is you start with your underlying assumptions, right? Your purchase price, if you're going to do like your cap rate for the market, if you're going to do any project management fee or an acquisition fee, all that kind of stuff, your loan assumptions, right? Your loan to value, your interest rate, any fees that you're going to have from your lender. What I really like is there's a sensitivity thing of, okay, if you're buying at a 9 cap, it's this. If you buy at or sell at an 8.5 cap, it's this. At 9 cap, it's this. If you want to be more conservative, you can do that here, and then you can structure in a refinance. So that's like your baseline assumptions, but then you're going to work on this sheet from this summary, left to right, right? So the first thing you're going to really do input from your market data is your ADRs and your occupancies to generate your RevPAR, really, which is your gross income that'll go into your offer model with all your expenses here. So that's why I wanted to show AirDNA here and how you do this. So what I like to do is go in here to the STR listings and filter by revenue. So that way you're looking at your market and you have the highest earning listings filtered at the top. So then if they're ranked by revenue, you can scroll down to find the kind of properties that are listed currently, find out what they're making and see how those compare to the deal that you're underwriting with what you expect it to operate as on the back end, right? So if you're buying a beachfront hotel and doing a really nice renovation like this one here, like this is nicely renovated, views of the beach, there's clearly a bunch of amenities down by the pool area, really nice design. Look at all that. So this one's making $150,000 a year. So if you're going to do that quality of renovation and that quality of property and that quality of location, then this is going to be one of your comps that you're using for your analysis. Now, that's probably not going to be the case because this is a really big condo building, a whole lot of beachfront. So this might not be where you're starting. So what you're going to do is essentially go through here, scroll and find the similar quality listings that you're going to buy. So maybe you're not going to be beachfront, you're going to be more in the city in Miami, like in a condo, maybe it's got a pool, right? This right here isn't, well, that one's beachfront too. So all these higher earners are beachfronts that are doing 100,000 plus. So maybe you need to keep scrolling down. And this is, like I mentioned, more of that subjective thing where you've got to find that quality that matches what you are going to provide through this revenue filter and say,
okay, now I'm finally here. These are my comps at, about 97, 96, maybe 95K, because we're not on the water, but we've got water views.
But then you start to narrow this down and can use that as your baseline. So that is how I like to use AirDNA for my, what I call quick and dirty underwrite, right? Just to get the feel of, all right, I'm purchasing at this price. here's what the units can generate. If that doesn't make sense, let's just say we'll put a 50% expense ratio on it to get a quick and dirty analysis. Will I make enough money to make that investment worth it? So you can use that for this. Now, where I said that AirDNA is not the one-stop shop for hotels is because it's not. So one thing that I really like is the STR Trend Report right here. And this is a paid report that's $660, but is fantastic data for your market. And it's gonna look something like this right here. So this is an old STR report I did. And you're going to get historical numbers for the occupancy, for the ADR, for the RevPAR, the supply and the demand, and the revenue, which you can also use this to help calculate your seasonality, right? Because you can see how it varies by month, and your variable expenses are also going to vary by month because as you have less guests, you're getting less revenue, but you're paying less in variable expenses. So that's why breaking out monthly is important, and that gives you that. But for, looking back, I think this one's, 8 years, you can see how occupancy has varied, how the ADRs have varied. And hopefully, if you're buying in the right market, occupancy should be somewhat similar or hopefully growing, but you should see that growth on the ADR to know that over time, people are willing to pay more, demand is going up, rates are going up. That is a market where you want to be in. So this STR Trend Report from str.com is really good. So what I'll typically do, because this is a paid report to get out this printout, is I'll start with AirDNA, or maybe use like a Google search to find hotel rates as well as like the Airbnb rates to do my analysis. And then once I get under contract, then like I know I'm moving forward the property, then I'll make the commitment to spend the whatever, $660, because I want to do, even me at this level, it's like trying to get as much data as I can without spending the money. But once I'm under contract, I'm like, all right, now we're going to spend whatever, $1 million+ on a hotel. Yeah, I'll spend $600 on a report to get the best data out there. So now going back to the acquisition model, that's where you get all this information to input it into your income and expenses. And the RevPAR calculates up into your total. And then that is what pulls forward. See, that's 6.3 million. That is what pulls forward to your gross revenue on your offer model, right? So you got the chance to put in your historical financials in these columns, and then your offer model is what's going to calculate out to the rest of the sheet, right? So you'll take your income projections, your expense projections, put them out on a monthly basis, and then roll up to the out years to say, okay, here's our cash flow in year 1, which is probably going to be a little bit lower because you're going to do a renovation period, and then start to increase year 2, 3, right? Then hopefully get you set up for a refinance in year 3 or 4. Then you can sell in year 5, 6, 7 and return investor capital year 3, hold for more cash flow, sell and exit the thing. So as you work through all those details, right, of, all right, we're doing a renovation and we're going to have a certain amount of spend each month. That's also going to affect the amount of units that we have available in that month. So you can input your detailed renovation cost of where you're going to spend all your money in your renovation, how many months it's going to take, and how that affects your spend, which will then roll up into your monthly cash flow analysis so that you can actually track by each month how much you're earning, how much you're spending, and what your cash balance will be at the end of that period, right? And you want to be really cautious of making sure that your cash balance stays above whatever minimum threshold you've set. Maybe it's whatever, 50K, 100K, depending on the property that you're buying. But you don't want to get in a spot where, like I did at the very first hotel deal. So because the renovation was going on at a time where we were spending a bunch of money and our seasonality was making us, dip negative into cash flow because we had just launched, we needed more capital. So you want to underwrite for that and avoid it, right? So from here, that's on your monthly cash flow. Then it rolls forward to your annual. So this will basically sum months 1 through 12. This will be 13 through 24, and then year 3 it starts calculating off of yearly. So really the monthly cash flow is for your first 24 months, so you can know where all your money's going. And then you got a summary of your cash flows, right? This is really going to be how all the money flows over the deal, both to you, to the investors, and that's an important thing if you're raising money. Your seasonality, which I talked about, that'll calculate back to the monthly because that's an important factor. And then what's really good here, if you're doing a waterfall, say you want to hit, after you return whatever 15, 20% to investors, that maybe it goes from a 70-30 before that to a 50-50. So if you can really deliver to your investors and drive a lot of value, you can structure that in as well. this gets complicated, I would suggest leaving this in its base settings unless you have the experience with that, or reaching out with the question if you want to set it up so that you can be rewarded for the value that you're driving. And then you've got your LP returns and your GP returns, which is really important. On the LP returns, this is what I'm talking about that you need to underwrite to, right? You're trying to hit an IRR, an equity multiple, and your cash on cash return in this column for the investors. So if the deal looks great, like you say, hey, we're gonna cash flow $100,000, right? We're putting $1 million in, we're gonna cash flow $100,000, and that's a 10% return. So that's really good, right? On a base cash on cash return. But if you're doing a 50-50 split, the investors are only gonna get $50,000 of that, right? And then their return is a 5%. So they're probably not gonna be too excited about that. Now, what you can do is structure in a pref to where all the cash flow goes to them before it goes to the investors until a certain thing, or until it goes to the GPs, until a certain threshold is met, which you can put on the waterfall tab. But this is really what you're underwriting to if you're raising money. So keep that in mind. And then finally, you can see on the GP tabs what the investors, what you are going to be making, what each partner is going to be making. So that's an important thing to know as well. So again, this is what you guys have available to you. Go to the link below, download this, start using it, reach out if you have questions. And I hope this was helpful, not just from a standpoint of getting the sheet to be able to underwrite deals, but more of the subjective that goes into it, like the context of how to underwrite deals and what you're actually looking for. Because I know switching asset classes, that's always like the most important thing. And that's the most questions that I get from those in the mastermind group is, more of the why behind the number. So I wanted to highlight that for you guys. Of course, if you have any questions, put them in the comments below. Hope this was helpful for you guys, and I'll see you on the next one.